How are you going to fund your startup? Starting a business is tough, especially when it comes to deciding how to fund it. Should you go it alone, stretching every dollar, or bring in outside investors to fuel rapid growth? Each path has its perks and pitfalls, and making the right choice can define your entire journey as an entrepreneur. Before we dive in, don't forget to subscribe. We're always sharing insights to help entrepreneurs like you succeed, bootstrapping or raising funds. Let's explore what's best for your startup. This will affect many things in your startup. 1. Control. Bootstrapping. You're the boss. With 100% ownership, every decision is yours to make, and you keep all the profits. Raising funds. Here, you're giving up some control. Investors usually get a say in major decisions, and as more funding rounds happen, your ownership share can shrink. Which is better? If full control over your company matters most to you, bootstrapping keeps you independent. But if rapid growth is your priority, outside funding could offer what bootstrapping can't. 2. Flexibility or accountability. When bootstrapping, flexibility is a major advantage. With no investors to answer to, you're free to pivot and make quick changes as you see fit. When raising funds, investors bring accountability, expecting you to follow through on agreed goals and growth targets. This can drive focus, but might feel restrictive if you value freedom to change directions. What are your goals? If you want to stay agile, bootstrapping offers that freedom. But if you thrive with accountability and mentorship, investors can keep you on track. 3. Financial freedom versus financial backing. When bootstrapping, there's no debt and no one to pay back. But you're often using your own savings, which can be risky if things get tough. With outside capital, you have more resources for expansion, hiring, and development. However, with every funding round, there's also the risk of losing ownership and control. Here's a pro tip. Think about what you need right now. Are your goals achievable with the resources you have? Or would external funding be a game changer? If you're finding this valuable, hit that like button. It really helps us bring more content your way. 4. Speed and scale. When bootstrapping, growth is usually slower and more sustainable, with a strong focus on profitability from the start. When raising funds, faster growth becomes possible with more cash flow, letting you scale quickly and compete aggressively. However, this can also add pressure to meet investors' high expectations. Ask yourself, do you want steady, sustainable growth, or do you need speed to capture a market advantage? 5. Stress and pressure. When bootstrapping, the pressure is high, especially if you're wearing multiple hats and personally funding your startup. When raising funds, investors can provide support, but they can also add pressure, especially if they push for rapid returns or take a seat on your board. Tip for new founders. Think about where you'll get the most support. Are you comfortable going it alone? Or would strategic partners help you stay focused? Each path has its unique challenges and rewards. By considering these points, you can decide which path aligns best with your vision and goals. How to approach raising funds and making it work for you. When you've decided that raising funds is the best route, knowing where to start can make all the difference. Each funding stage supports different parts of your journey, from early growth to scaling up. Let's break it down step by step. Don't forget to hit that subscribe button if you're finding these insights helpful. 1. Bootstrapping, self-funding. This is the DIY phase. Using your own savings or early revenue, you keep full control while proving your concept. This approach works best in the beginning, when you're building your first version and testing the market. Remember, many successful startups bootstrap at first to establish traction before seeking outside capital. 2. Friends and family. It is an early stage. When you need more than your savings, friends and family can be a valuable funding source. While it's typically more accessible than formal funding, keep in mind that this comes with personal risk. Pro tip, make sure everyone understands the risks involved to keep relationships positive. 3. Angel investors. Angel investors are typically high net worth individuals who fund startups in exchange for equity. They often bring valuable mentorship, especially useful in the seed stage, as you start growing beyond the idea phase. Why it works. Angels often invest early, when traditional venture capitalists aren't ready. Plus, their guidance can help you refine your business model. 4. Seed funding. Seed stage. The official first round of funding usually comes from a mix of angel investors, seed venture capital, VC firms, or startup accelerators. This round is critical for developing your product, growing your team, and finding product market fit. Think of it as a launchpad. This is where you start building the foundation for future rounds. Fifth, venture capital VC funding. In this stage, Series A, B, C, and beyond take place. In Series A, you've found product market fit, and now it's about scaling. Venture capitalists come in at this stage to help you reach larger markets and refine your offering. In Series B, you're growing fast. This round is for major expansions like entering new regions or launching significant marketing initiatives. Series C and beyond. At this stage, funding is about preparing for acquisition, IPO, or a massive market grab. Companies often use this for international growth or acquisitions. Key takeaway: each round of VC funding is like leveling up. As you progress, expect to give up more equity in exchange for bigger investments. 6. Crowdfunding. If your product has mass appeal, platforms like Kickstarter or Indiegogo let you raise funds from many small backers, often in exchange for perks or pre-orders. Crowdfunding is ideal for consumer products or innovative ideas with strong public interest. Consider this option. Crowdfunding isn't just about money. It builds a community of supporters and early adopters for your product. Another way you can fund your startup is 7. Debt financing, loans. You can do it on any stage. Loans or credit lines from banks or lenders offer a way to secure funds without giving up equity. This is most suitable for companies with steady cash flow, as debt needs to be repaid. Debt financing can boost growth without diluting your stake, but it's risky if revenue isn't consistent. 8. Initial public offering, IPO. It's in late stage. Going public is a huge milestone that allows the general public to invest in your company. An IPO often marks a turning point for major growth or preparation for acquisition. Why it matters. An IPO is a long-term goal for many startups looking to go big. It's typically pursued once the company is stable with substantial revenue. Every funding stage serves a unique purpose, and choosing the right one depends on where your business stands and where you're aiming to go. Subscribe to stay updated on everything you need to know about startup funding and growth. So, what's the verdict? Should you bootstrap your startup or raise funds? Both paths come with their own sets of challenges and rewards. The choice ultimately depends on your goals, your business model, and where you want to take your company. Remember, there's no right or wrong answer, just what's best for you. But here's the real kicker. No matter which path you choose, building a successful startup is all about execution. What do you think? Have you decided which path you'll take for your startup? Drop a comment below with your thoughts. And hey, if you found this helpful, don't forget to subscribe for more actionable advice to grow your business from the ground up. It's time to turn those startup dreams into reality, whether you're bootstrapping or bringing on investors. Thank you for sticking around till the end. If you're ready to dive deeper into the world of startups, check out our other videos and hit that subscribe button to stay updated on our latest guides, tips, and strategies.